Thank you, Nirav bhai. A very good afternoon to all of you, and welcome to the session on the art of financial statement analysis. Today, I have an opportunity to introduce our today's faculty, CA Shilpang V. Karia sir. He is a director in SVK FinValue Advisors Private Limited and partner in SVK Associates Chartered Accountants. He has an experience of more than 2 decades. He is carrying out valuation assignment since 2007-2008. He is carrying out valuation practice mainly as a transaction advisory, M&A valuation, pre-IPO and post-IPO placement valuation since last 14 years. He is carrying out valuation practice as a registered valuer since March 2019. He is working as an advisor to IPO for a company seeking listing on BSE NSE. He is working as a corporate advisor to companies being SMEs, mid-corporate, multinational companies, startup for advising on the financial statement analysis for valuation growth advisory. He has delivered lecture on SME IPO at a various professional business forum. He has delivered lecture on valuation at a various professional business forum. He has carried out more than 200 valuation assignment for various sectors, companies such as transaction advisory, compliance valuation, IPO, M&A, etc. He is regularly contributing articles in Valuation Professional Insight published by ICI RVO and ICMAI RVO. He is a co-chairperson Valuation Study Group Ahmedabad. He is a special invitee Valuation Standard Board ICI. Now I would like to request our managing committee member CA Nirav Agrawal to welcome the faculty with a memento. Now, without taking further time, I would request sir to take the charge and move the session ahead. Thank you.
Good afternoon, friends. First of all, I thank the Ahmedabad branch for inviting me on this special topic as the art of financial statement analysis. So we all are the chartered accountants, and we day in, day out, we deal in the financial statement only. So basically, we all chartered accountants knows that art. But let me share my experience, whatever little experience I have. I will try to share with all of you. You all are my professional colleagues, and definitely whatever little knowledge I have, I will try to share with all of yourself. So basically, when we say the financial statement analysis, so what are the purpose? Why the financial statement analysis needs to be carried out? Why we carry out the financial statement analysis? There may be lot of purpose, regulatory purpose. There may be the even nowadays, lot of stakeholders are analyzing the financial statement. Though we as a chartered accountant issue our audited financial to the board of director, but those are being analyzed by so many authorities. Nowadays, NAFRA has also started, stock exchange, SEBI, whoever. Everyone is analyzing the financial statement. So basically the duty of the chartered accountant to be a very meticulous in carrying out and preparing the financial statement has been also increased to the larger extent. So subject today given to me is a art of financial statement analysis. So let me add art of financial statement analysis for the valuation purpose, value investing purpose, because there are so many purposes, but I will restrict myself to the particular subject of the value investing and valuation purpose. So when we say for the valuation purpose, so the purpose can be for the merger and acquisition, for the IPO advisory, for the startup advisory, for the private equity placement. So there may be so many purposes where value unlock is required. So the financial statement analysis for the value unlock purpose. Nowadays, even the companies has started to giving the assignment to the chartered accountant as a value creation advisory. Means suppose any company wishes to come on the platform or carry out the unlock of their value 1 year, 2 year down the line. So they give the assignment to the chartered accountants that please advise on the value creation advisory. The transactions of the valuation has increased immensely since last few years. We had not learned before 10 years back that such a huge transaction was being carried out for the transaction as a transaction for the purpose of valuation. So the requirement of valuation to know what is the valuation has increased to many extent. So as a chartered accountant, though you may be in the traditional practice, but you should advise your chartered accountant as a value-added advisory to how to interpret the financial statement, how you can create the value in your balance sheet in your business. So that is the advisory, as a value-added advisory the chartered accountant can play along with that traditional practice. So when we say the financial statement analysis, it's an art and science both. But I personally say it is more of art. And art is being developed through experience only. When you come across the many transactions, when you conclude the transaction, when you sit with the investors, when you answer the questions of the investors, at that time that art's being developed along with the experience. So I would categorize my presentation in 4 parts: investment and valuation truth, financial statement analysis, financial ratio analysis, and discussion on ratio analysis on few practical cases. So for the valuation truth, why valuation truth? Because when I say when the financial statement analysis is an art, definitely we need to listen the who successful person as a greatest valuer, greatest stock investor, what they have said about that interpretation of the financial statement. We need to listen their statement. So that truth, that become a truth, and we acknowledge how they see the financial statement, how they interpret their financial statement. So we try to interpret certain few statements being given by those dignitaries. So James Ichner, who is since 35 to 40 years, he can be said as a greatest valuer of the USA. What he said, the value is a future looking. Investor buy tomorrow's cash flow and not yesterday's or even today's. So when we carry out the financial statement analysis, definitely we need to keep in mind that ultimately what investor looks for the future looking. The financial statement is only the starting point, because it is a gateway. It is a gateway of analysis. Ultimately the analysis starts when we as a chartered accountant or we as an analyst, first and foremost thing when we carry out those assignments, we demand is please give your financial statement. But we should not try to jump only into the figure of those financial statements. Definitely we try to arrive future. What's the future of that company, future of this industry based on those financial statements. So accordingly, James Ichner has again told that past performance is only relative to the extent that it is indicative of the company's future performance. So for analyzing the past performance, ultimately we need to analyze the future performance. Because if we invest at price say 100 rupees as on day, basically the company is going to take price of today's only, say 100 rupees. But to the investor, the value addition to their price will come only from the future only, whether it is able to give 100 or 150, 200. So that needs to be analyzed based on the financial statement and other related analysis. So basically, there is a difference between price and value. When we analyze any statement, we need to interpret what is the value out of it. Now, price is a transaction. Transaction closes at the price, but we try to acknowledge what is the value out of that. Whenever we derive more and more value and we pay the less price, it is the buyer success. That when value is more than price. And what is the seller success? Price is more than value. So we may also say new businessmen come and go, but it's the only cash flow that decides that you will be in the operation in long run or not. So basically we can say the cash flow is a bloodline of any business. Because ultimately if there is no cash flow, whatever capex, whatever real estate investment, whatever other assets being lying in the balance sheet, if it is not able to circulate the money, and if company and stakeholder is not able to get the cash flow out of that, then there is no meaning. So importance of the cash flow is being displayed by this statement. Today's people who hold the cash equivalent feel comfortable. They should not. They have opted for the terrible long-term asset, one that pays the virtually nothing and is certainly to depreciate. So Warren Buffett We know everybody the Warren Buffett, so no need to introduce who is the Warren Buffett. Warren Buffett has again told that, yes, there may be a good amount of cash and bank in the balance sheet, but there is nothing to attract out of that, because if there is a more than necessary amount of cash and bank balance in the balance sheet, then definitely you should be cautious. As an investor, you should be cautious, because if there is no other alternative business opportunities, so why so much cash and bank balance is kept in the balance sheet? If there is along with the cash and bank balances, company is also having the borrowings on other side. So why there is a reason? Why there is a reason to keep the more than necessary cash and bank balance? Because ultimately there is a time value of money, and along with the time, it depreciates, money depreciates, value of time, value of the money depreciates. So definitely if there is a more than necessary amount of the cash and bank balance, then you should be very cautious. Warren Buffett has again said that it's a far better to buy a wonderful company at fair price than fair company at wonderful price. Only when you believe that company is a wonderful, you should consider that price is undervalued or overvalued. So he tried to say that when you see any financial statement, don't jump into the only figures and say, oh, what is the P, what is EV, EBITDA multiple, it is a reasonable, overvalued or undervalued, not only basis of only those figures. You need to interpret, you need to know the business, you need to know the industries. Without knowing everything, you should not conclude that this is overvalued or undervalued. And you try to evaluate that company only and only if the company is a wonderful. You don't purchase any stock or purchase any company only if that price is a fair, so I want to purchase. Whether company is a fair to purchase, if there is a company is fair to purchase, then only as a next step you should evaluate that price is overvalued, undervalued, fair price or not. That you should evaluate at a second stage. So Ramdev Agrawal, we can say he can be told as a Warren Buffett of the India. So what he has told, that focused on return on equity and not earning per share. So when you analyze the financial statement, don't see the earning per share, because earning per share is a mixture of your capital structuring also. Because if you compare company A with a company B, so earning per shares may be, you have to see the return on equity as a overall of the company, not earning per share. So he has told that focus on the return on equity. Again, he told that secret of sound investing is a margin of safety. So by that statement, he wanted to say that you need to analyze any company as a margin of safety. That suppose due to any whatever situation, the company's valuation and company's business go down by say 20% or 30%, what could be the situation of the company? And if that sufficient margin of safety, even if the business of the company is down by the 30% and that margin of the safety is available, that company is able to meet their fixed overheads, their interest liabilities, then if those margin safety is available, then you should try to evaluate this company for the investment. So Warren Buffett has again said, I am a better investor because I am a businessman, and I am better businessman because I am investor. So by this statement he says that before you invest, you become a businessman. You make an analysis that in a manner that you are a businessman. You want to put your money as a project ownership. In that manner, you analyze that balance sheet, that financial statement, that returns, prospective returns, not directly try to jump into only the figures and figures of those financial statement. So now, mentioning the importance of the interpretation of the financial statement at last, Warren Buffett has said, unless you are willing to put in the efforts to learn the accounting, how to read and interpret the financial statement, you really shouldn't select the stock by yourself. So if you want to put the money as a long-term investor, definitely you should be able to interpret the financial statement by your own way. Don't depend on others' advice. So now let's come on to the financial statement analysis. I have 4 to 5 segments I have segregated for making those analysis. I have tried to bifurcate the key parameter of the analysis. What's the key parameter of the analysis? When you have a balance sheet in your hand, from where you should start? So you should not directly jump into the financial figures. You should start to know the industries, know the promoters, companies, business model, and auditor. These advice is for the fundamental analysis. It is not the advice for any trading activity, because for the trading activity, you purchase the stock today and you sell the tomorrow. You need not to carry out this type of fundamental analysis. So this type of fundamental analysis is carried out with the concept that you are going to invest for the long term, or you are going to advise your client for such investment. So know the industry's promoters. Whatever may be the best company, but if promoter's integrity is not there, you should never invest into those stocks, because promoter integrity is a prime for making any investment. If promoter integrity is there, promoter capability is there, whatever may be the business may be tomorrow up, tomorrow down. We don't know that every business remains green every 10 year or 20 year. Business may have their own cycle. But if promoter's integrity and capability is there, then definitely your stocks, promoter will be able to give you the return on the investment made by you. Business model, company, industries. Nowadays, auditor is also very important, because the financial statement figures, and we can say that trustability on the figures being displayed on the financial statements are depend on the integrity and of the auditors also. Now, after knowing all these parameters, you should focus. What are the key valuation drivers for that company? Because every company would have different valuation drivers. Certain company would have locational advantage. Certain company would have number of customer, repetitive customer, reputed customer, technology, branding, brand ambassador, marketing budget, so and so. So basically, you should analyze what is the key valuation driver for the company I am going to invest. Why this is necessary? Because any impact on those key valuation driver will impact your cash flow, will impact your profitability, and you should carry out the sensitivity analysis on the key valuation drivers vis-a-vis the profitability. Suppose key valuation driver is X on as on date, and if it impacts by 20% or 30%, what would it impact on their financial statement? Whether financial statement are able to meet their fixed overheads, even after the 20 to 30% impact, what we call it as a margin of safety also. What are the economic modes? Means what are the competitive advantage? Whether the company have any competitive advantage, and whether that competitive advantage is sustainable or not. Today it may be having that competitive advantage, but tomorrow, no, we can't say that any company is a non-competitive. There is immense competition. Even if competition is not as on date, tomorrow any new player will come and will start the competition. So if you are just investing on basis of the competitive advantage, definitely you should look that if tomorrow those competitive advantage will not be with the company, then whether its valuation will be impacted by how much, to what extent. Now, while analyzing financial statement, you should try to analyze the normal level of performance. So what's the normal level of performance? So as a chartered accountant, as a financial analyst, when you analyze the statement, definitely there may be other incomes, foreign exchange income, any other capital gain income. There may be so many such income which is not sustainable in future, or it is not repetitive in the nature. So those amounts should be excluded. We need to consider the profitability of those amount only for analysis purpose, which is our core business, and we are investing in that core business activity. Those amount only should be considered for the your financial statement analysis. So now what is the CAGR? That is very important to know. When you invest into the company, you should see what is the CAGR of the industries vis-a-vis the CAGR of the company. And because as a unilaterally, if you analyze your balance sheet, then you can't conclude anything. You need to analyze the balance sheet as a trend analysis, as a historical analysis, and with the peer group companies. Another very important aspect which needs to be carried out is a core working capital. Because you will appreciate and you will understand that lot of company are nowadays putting their lot of money along with their business increment also. More than business increment, they are putting more money in the working capital. So when we say there is a growth in the business, but we also need to analyze, suppose there is a growth in the business by year to year 20%, 25%, but along with that, if they are putting money into the working capital more than 25 to 30% on incremental basis, then definitely you are putting more and more money in the working capital. And if one day any amount is stuck up in the working capital, then company will not be able to sustain and run their business for the longer period of time. So working capital analysis as an item to item, trade receivable, trade payable, as inventory, as a percentage to turnover should be carried out. So operating cash cycle of the business vis-a-vis the previous year and vis-a-vis the peer industries is very important to be carried out. What another point you should carry out as analysis is capex to turnover ratio. There may be a capital intensive industries, there may be a service industries. So these all factors I am saying as a generalized. It may be applicable to certain company, it may not be applicable to the certain company. But if it is a company is a capital intensive, then definitely you should, this ratio is very important, capex to turnover ratio. On every money put as your capital expenditure, what amount of turnover it gives. This is very important. Capex addition vis-a-vis business plan. So when we say growth, the growth comes from the future business plan. We as a chartered accountant also should not only look to the financial statement, should also analyze the full annual report, investor presentation of the peer group companies, the management statements of a future outlook, because by those statements we'll be able to acknowledge and understand what are the future plan of the company and whether company has put at those plan that can be analyzed vis-a-vis the any capital expenditure incurred in the face of the balance sheet is there or not, that whether company says yes I have business plan to put 100 crore in project, but whether company has initiated to incur those expenditure that is available on the face of the balance sheet or not. Excess asset or assets deficiency. So as an analyst, to analyze the debit side of the balance sheet is very important. When you analyze the debit side of the balance sheet, you need to interpret each and every line item of the balance sheet, whether those assets are excess, redundant, whether are aligned with my operating business activity or not, whether those are aligned with the market peer group statistics, comparable companies or not. So excess assets, why excess assets should be? Because those assets gives you earning. If there are the excess assets, then overall your return on equity and return on capital employed will be impacted. So excess asset and asset deficiency vis-a-vis benchmark of the industry should be analyzed. Whether any redundant assets exist in the balance sheet or not, those should be analyzed. What are the key valuation drivers? Master of all the analysis is return on equity and return on capital employed. At the end of the day, for the promoter, for the investor, what is important is a return on equity and return on capital employed. Whatever analysis you carry out, the master of all analysis is the return on equity and return on capital employed. If your assets are properly utilized, if your assets gives the appropriate return as per your expectation, then definitely it will be showing its result on the return on equity. Now, if company is saying that, yes, I have business plan, then you need to see that there are a future cash flow is available with the company to invest into that or not. Means ROC and the proper proportion of its profit that company invest into the growth. If company is not having a sufficient cash flow in their balance sheet and they are unable to invest for their growth plan, then definitely there is no growth. And if there is no growth, your money invested would also not have any growth. So what amount of profit and return on capital employed is available for the future growth is very important to derive from the balance sheet. Capital structure of the business. By capital structure we say is debt or equity both. Debt is also capital, equity is also capital. So how the debt and equity are deployed and what is the financial leverage are being carried out to maximize that we also understand later on. What is the financial leverage mechanism is being carried out to maximize their earning on the return on equity. How much the debt the company employ relative to the equity means that is a part of the capital structuring. What margin means there are many questions are asked. What margin of safety? What debt equity ratio is available? When banker are analyzing the balance sheet, they say 2:1. But 2:1 is not a ratio, permanent ratio for any company or any industries. We should not analyze that 2:1 is the best ratio for any company. It needs to be understood along with the margin of safety. Margin available. It needs to be because what is the actual return and break even of the company, those also should be analyzed. When you what is the risk appetite of the company, that should be analyzed along with the margin of the safety. Interest coverage ratio, credit or liquidity perspective. So cash flow analysis is extremely important. When we approach any investor, when we sit with any investor for selling the stock and for convincing on the investment, the first and foremost page they open is only the cash flow statement. They judge the entire health of the company on the basis of the cash flow statement. They don't refer to the P&L balance sheet. Entire health of the company is being judged from the cash flow analysis. So whether company is putting money or whether company is generating money. So at the end of the day, what is important for the investor is cash flow generating capacity of the company. Investment ratio. Whether company is consuming more fund than it is generating, that is the investment ratio greater than 1. If I am generating, say 100 rupees, and if I am putting the investment more than 100, so yes, company sees the potential, then definitely, company will definitely borrow the money, company will deploy the capex plan even more their own generation, internal cash generation. Dividend payout ratio. So when we say certain investors are very happy when company declares the huge amount of the dividend, but dividend payout ratio, if it is at the cost of their future growth plan and future investment capacity, then it is definitely very cautious because ultimately investor doesn't invest to earn the dividend amount, but investor invests to have the value creation in their investment value. Analysis vis-a-vis past trend and industry segment. So there are two type of analysis is very important when you put into the Excel sheet. It is a past historical analysis and analysis with the peer group company. And to select the right peer group company is also very important because if you will not select a right peer group company, then all the analysis will not be you will not give a correct result. So sales growth and quantitative growth. When you see any financial statement and you see that yes, company has a growth from 100 crore to 125 crore, 25% growth in the turnover, you should not be happy because it may be due to the sales price and which is universal to everyone, every player in that sector. What is quantitative growth? That needs to be seen as a actual growth of the company. Operating profit margin, sensitivity of free cash flow to the key valuation drivers, what we already discussed. Core working capital item along with the sales turnover. Incremental investment in working capital with the incremental sales. That is very important. I will also explain that into the Excel sheet later on. Incremental investment in fixed asset vis-a-vis your present installed capacity and utilization. Suppose your present installed capacity is also underutilized, then why company should have the more capex plan? So all those factors also should be analyzed. ROE in ROC is definitely the master of all analysis. Now, overvalued assets, redundant assets and non-operating assets. So which are those assets you should look into when you analyze the financial statement? Increasing inventory level vis-a-vis sales, obsolete slow-moving, non-moving stock and realizable value of the stock valuation methodology adapted, longer period receivable, expected credit loss. So this list can be more exhaustive also, but I have tried to put the overall the broad parameters. Longer period work in progress. If company expected to start their new project within 1 year, and if it runs into the 2 year, definitely it's a loss. Litigated assets and revenue driven from it, deferred revenue expenditure. So nowadays for the startup company, really this deferred revenue expenditure mechanism needs to be very analyzed very cautiously, because startup company put lot of expenditure on the deferred revenue expenditures, means a future earning potential. Now we need to analyze, actually those deferred revenue expenditure are deferred revenue, and definitely it is a potential to give the future revenue or not. Investment carrying low rate of income vis-a-vis the ROC of the operating assets. Suppose company is putting amount, any investment in another company, maybe listed or unlisted. You need to analyze whether our ROC of the company, means ROC of the business in which we invest, if it is more than the ROC of the company in which the amount is invested, then why company is investing? Whether company doesn't see any business potential in their own business, why it is investing in another business? Contribution of intangible assets on revenue and impairment of intangible assets, because nowadays intangible assets are being purchased as a brand, as a goodwill, and if those, when company purchases any another company, at that time company pays for the brand, for technology acquirement, for the goodwill acquisition, but it may happen that company would have paid more amount than it should have been. Now next year, whether company is carrying out the impairment testing or not, otherwise the intangible assets would not give you the appropriate return on capital employed on entire the assets being deployed by the company. Performance of the group investment vis-a-vis the level of overall investment. So nowadays we see that there are a lot of subsidiaries, second level subsidiaries, and company put lot of their money in their subsidiary companies. As a investment, subsidiary company doesn't give you a direct return. Why company is putting those money? It may be as a part of consolidation, yes, then it's okay. If it is giving as a consolidation of the company, it is in the as a basket of the company, as a subsidiary company, then it will definitely, as a consolidated profit and loss, it will give a result. But if company has a group company, not a subsidiary company, where director are interested, not company directly interested, but director or promoter are interested, and company puts the money into those companies, whether those companies are aligned with our business activity or not, those should be also analyzed. And why we are putting money into those group company, whether it is giving you a direct benefit or indirect benefit in our company or not, those should be analyzed, because this tool is also being used as a diversion of the fund. Excess cash than business requirement that we already discussed. Excess marketable securities, because if company have a surplus cash and they put their money into the marketable security, we are happy that yes, company is a liquid company. But marketable securities may be carrying out 7% interest rate, 8% interest rate, and opportunity cost of equity is very higher than the earning of the marketable securities. We say the expectation of what is opportunity cost of equity? Expectation of any investor. So expectation of investor is a 15% or 18%, and vis-a-vis the return on your marketable securities 8%, 9%. We need to see the financial statement. हम बोलते हैं ना कि एक मारवाड़ी बंदे के स्टाइल में देखना चाहिए, तो एक मारवाड़ी बंदे क्या बोलते हैं कि भैया इस साल में मेरा कुछ अर्निंग ही नहीं हुआ. हम बैठते हैं ना किसी के साथ, प्रोमोटर के साथ, यार कुछ है ही नहीं, धंधा ही नहीं है, प्रॉफिट ही नहीं है, तो बोले क्यों भाई, ये तो है बैलेंस शीट में तो है. अरे यार मेरा एक्सपेक्टेशन 15% का था और आया 12%, तो घाटा है 3% का. सो व्हाट इज योर एक्सपेक्टेशन? कॉस्ट ऑफ इक्विटी इज ए एक्सपेक्टेशन ऑफ द what is opportunity, other opportunities available to the as an investor to deploy that fund rather than in A business to B business. That is a opportunity cost of investment. It should be cost of equity is always higher than the cost of debt. That is in form of the opportunity cost of equity. Excess real estate investment vis-a-vis its opportunity cost. If company is into the another business line, and why that company is putting their money into the real estate business activity. Luxurious investment in name of the company. So those all entire debit side of the balance sheet should be analyzed whether it is giving return to the company or not. If it is not giving the return to the company, then definitely it will impact on your overall return on equity and return on capital employed. There are certain off-balance sheet item also we should not ignore. So just I have tried to put the certain points, and it list can be more exhaustive also. Qualification, we should not ignore the qualification put by the auditor. Yes, definitely we as a auditor will definitely look into that, but investor may not look it, because every off-balance sheet item which impact your financial statement needs to be seen cautiously. Other negative reporting in the audit report, accounting policy which affect the financials of the company, impact analysis of those accounting policy, tax dispute and other contingent liability, probable product liability, warranty claim, third party claim, labor issues, legal right over the brand, IP, environment liability, credit rating. Credit rating is also very important to know whenever you invest. Collateral security is offered, because if bank is insisting more amount of collateral securities, then we can definitely analyze that bank is also not trusting the company in the way it should trust. Then definitely we also should, as an investor, should be cautious. Adequacy of the insurance coverage, all those items should be analyzed, because it may impact your future financials. Now, risk analysis. As an investor, what is important for you? You should first and foremost, you should, what is the risk in this investment? When you analyze the risk, then definitely you will have more confidence for investment. So there are internal risk and external risk. So as operating leverage. Now, as operating leverage, we can say high operating leverage and low operating leverage. When there is a high fixed cost and low variable cost, it's a high operating. When low fixed cost and high variable cost. What is better? When we say for the growth oriented company, high operating lever is a better, because why the high operating lever is better for the growth oriented company? Because that company has already made their fixed overhead. Now whatever additional earning is giving the maximum amount of return due to the low variable cost. So for the growth oriented company, the high operating leverage is better. And for the company which is a volatile in the business, low fixed cost and high variable cost is better. Now financial leverage. Financial leverage is tool being used to maximize your earning on return on equity, because the debt and equity mix should be always played and should be always put on as a financial expert to maximize return on equity. What amount of debt you should borrow? You should compare the return on capital employed of the company. What is return on capital employed? Irrespective of any capital structuring, irrespective of debt and equity, what amount of return available to the entire business is a return on capital employed. Now we should compare what is cost of debt available to us and what is the return on capital employed on entire capital employed. If there is with the sufficient margin of safety, if return on capital employed is a higher than your cost of debt, then definitely you should leverage on the financial side. You should put certain amount of the debt also into your capital structuring. That will maximize the earning on the return on equity. But how much amount to borrow up to? It is not by that. It is not. We should not look that we should borrow the 80% or 90% because I have a sufficient margin of. Ultimately, the risk, there is also risk appetite also we should analyze along with that. Interest coverage risk has to be analyzed along with the margin. Because if the company is having the low margin business, then definitely any change and any volatility into that business will definitely impact their fixed expenditure like the interest coverage. Wrong business model risk, product risk, technology risk. So list can be more exhaustive also. Yes. No, we need to realize vis-a-vis the market.
Yes, in the market only they have come out with the IPOs. Now the valuations are going up. How do we
So you are talking about the startup company or other companies, normal company?
Startups they were 5 years back. Even now they are startups because they are making losses, full losses.
See, when you analyze any startup company, for and foremost thing you should do, you should first of all segregate your balance sheet into operating activity and your future earning capacity earning, because startup are those companies those doesn't have any capex, but the maximum amount of their expenditure are being incurred as a deferred revenue expenditure for future business activity. So when we say that Swiggy and Zomato are incurring so much loss, and why investors are putting the money, so much money? So investors are not foolish. Investors definitely carry out lot of working, but we as an investor, we look into on the face of the balance sheet and we comment that yes, there is a loss. Why they are putting the money? But they analyze the future of the company. They sit with the investor. They sit with the promoters of the company. They understand the business. They carry out the huge exercise. They bifurcate the balance sheet, and they bifurcate the balance sheet in a manner that what are their future deferred expenditure, those they put into the balance sheet item is their own analysis. What investor will do, suppose I am incurring the marketing expenditure of 50 crore as on date. Though as a accounting policy I need to debit it into the profit and loss account, definitely it will impact my profit and loss. Okay, it will eat as a loss only. But as an investor, those 50 crore marketing expenditure are meant for the future. So what they will do, they will remove it from the profit and loss account. They will normalize. They will try to normalize the financial statement in the manner, in the business model appropriate to that company. They will put those future any expenditure with related to future potential earning into the balance sheet, and they will try to analyze that whether for the operating activity only, whether company has a margin or not.
Actually, there is no margin. Out of top 100, 98 are in losses.
They are losses because you analyze the balance sheet as a total amount of expenditure debited into the profit and loss. But you need to bifurcate what are those expenditure which is meant for the future. Huge amount of expenditure is being 90% of expenditure is incurred for the future activity only. Technology expenditure, their platform development expenditure, their marketing expenditure, their staff training expenditure. All those expenditure are meant R&D expenditure. Those all are meant for the future activity only. Though they have been debited to the profit and loss, so why we are on the face of the balance sheet we see that yes, it's loss and investors are putting the money. But basically they analyze the balance sheet in this manner.
So right now there are no standard formulas for analyzing those type of balance sheets. So from valuation angles we can do it, not from the financial angles.
Yes, from valuation angle only you have to do. Ultimately, we are analyzing balance sheet from valuation angle only. Right now, what we are discussing is from the valuation angle. Why valuation angle? Because it's for investment. And we see financial statement analysis for the investment, definitely there is a growth in those investment or not. That is, we need to see it as a valuation angle only. There may be lot of external risk, and it may be company to company we need to analyze about its applicability, market risk, forex risk, commodity price risk. If company is dealing in certain commodity price, then means any commodity items or any commodity item is their raw material, then definitely any fluctuation in that commodity price risk will hit their profit and loss. Crude oil price risk, interest rate risk, inflationary risk, political risk. So it depends which type of risk is applicable to which company. If any company is having their business model which is aligned with any political party, okay, then definitely tomorrow there is a party and tomorrow there is a B party, there is a risk associated with that company, and we need to analyze accordingly. Natural calamity risk, if company is situated in certain location where there is a high risk calamities, so definitely it needs to be also analyzed. Market liquidity risk. What is market liquidity risk? Whether any buy and sell price is available for that company or not in platform. That is a liquidity risk, market liquidity risk. So I have tried to, I will go through that quickly. I will share this presentation only. So as a item to item, I have tried to put the, what is the analysis point we should see. Suppose there is a property, plant and equipment, what point we should analyze. I try to put it into that, so we as a analyst, we do not miss any factor which is applicable to the respective company. Capacity utilization, quantitative turnover, for capital work in progress, aging of the capital work in progress. For the investment property, when we say as a investment property in the industry terms, the investment property is for earning the rentals. And if company have their own business potential, why company should put the money into those investment property? Goodwill, if any business is acquired, definitely internally generated goodwill should not be recognized. But if company requires any business and high amount of goodwill is being paid, so for next year we should also see that whether goodwill is tested for impairment or not, whether goodwill is giving additional revenue or not. So all this analysis is as a fundamental analysis for the long-term investment, because you will say that as a trader, I do not have time to carry out so much analysis for putting the money as a short-term investor. Other intangible assets like a goodwill if acquired, so aging of those intangible assets, whether that intangible asset is giving additional revenue vis-a-vis your overall investment or not. Right of use assets. So if the companies are in the business like a retail business, then definitely their location is very important for them. And if those locations gives them business, so what are the right of use assets, ROUs available for the company? And if all the locations are available for the limited period, then definitely the business will be impacted. Investment in subsidiaries should be analyzed very cautiously. Financial assets investment, quoted and unquoted investment also should be analyzed very cautiously, because if the company has own business opportunities, why we should invest into those. Non-current assets, you will see there are investment, there are figures in other non-current assets is even more than current assets. So definitely you should look into that, what are the content of that, and you should try to understand, because it doesn't give any revenue. Inventories, methodology, valuation, slow moving, trade receivable, cash and cash equivalent, loans and advances, definitely it is for the operating activity or not, other current assets. So all this content, definitely we as a chartered accountant, we definitely know. So let me go speedily go. These are the revenue from operations. So you should try to bifurcate year-to-year growth. What is if there is a branded company, then definitely it is giving a, compared to their peer unbranded company, whether it is giving a per unit any additional realization or not. Whether other income is higher in proportion to their normal business activity, that should be analyzed. So cash flow, extremely important, as I have discussed, extremely important to analyze is a cash flow. So as we say very beautifully, cash flow statement is really, if you analyze in depth, really it's very beautiful. Cash flow statement is beautifully can be analyzed to understand the company. So let me say that the cash flow from, we start, definitely we know that we start from the profit before tax, and we add and deduct that non-operating activity. So first of all, you should refer the line cash flow from operating activity, so from operating activity before working capital change and after working capital change, because that is very important to analyze. What is the cash flow before working capital change and cash flow after the working capital change? Because at that level you will be able to analyze that whether company is a putting money or company is a able to generate the money, generate the cash flow or not. Because if there is a efficiency, the working capital management is being analyzed from between these two line items. Now, when we say investing activity, so as a investing activity, we should bifurcate that whether those all investment are meant for their operating business activity or not first. And out of the operating business activity investment, what amount of proportion is being deployed from their operating activity and from their borrowing activity. So let me move into the financial analysis tool. So as we rightly know, the ratio analysis is the tool widely used, and let me discuss certain ratio analysis tool being used for carrying out the financial statement. And if you have any question, anybody can ask. I think we can discuss as an interactive. Okay. Okay, we will also discuss the Excel. I have also the Excel sheet. We will also discuss on the Excel sheet also.
How do we use this analysis, value analysis by using AI? Say for example, ChatGPT, Bard. Can we use it? Because I've seen a video where all this ratio analysis just put this balance sheet in Excel format, and they will analyze all the ratios, and they will give you the advice also that whether it's better to invest or not.
Ultimately, same result is being given by the software also. Even if we use the software, then definitely it will give also analysis, but you will not apply your mind along with that. And when you want to invest as an investor, then definitely your mind application should be associated with all these analysis. So I personally believe that on those, any analysis being given by the software, any software, or yes, definitely you can use only for your analytical purpose, but ultimately you should be able to apply your own mind, and you should not depend on any advice which is being given by the ChatGPT or any other software. Ultimately, you know the industry, you know the promoters, you know the sectors, and you study as a vis-a-vis peer group. All those activities being carried out as by application of mind only. So definitely, I don't think that we have not tried and tested as a result up to now.
But what I see is that whatever I'm thinking that whether I should do or not, whether should I invest in this or not, he will give me more reason whether you should invest.
You should use it as a statistical analysis only, but ultimately thereafter only you should apply your mind. If you get so much ratio analysis and so much analysis which you need not to carry out in the Excel, so definitely you should use. But ultimately interpretation based on those needs to be carried out by you only.
The objective analysis
Hello.
can be done by IA, and the subjective decision making can be done by your mind.
Yes.
Objectively, 90% of the analysis is they conclude that this is worth investing, not worth investing, with reason.
I don't personally believe that you should refer those worth investing or not worth investing. You should use only as a analytical tools. But thereafter you should apply your
Subjective things like a politically connected group,
yes,
prevailing group,
100%.
or the Tabateli group, or the
And when we say the when we say financial statement analysis is art, this is only art. Otherwise, definitely you will not be able to. On the basis of the ChatGPT, everybody can be able to, if invest, then definitely it will be, in my personal opinion, it will be a risk. Let's see in the future how it gives the result. So broadly, we say liquidity, solvency, efficiency, profitability, valuation, 5 major segment of ratio analysis we carry out. Is a current ratio, quick ratio. Definitely we carry out all those analysis. Everybody know what is the current ratio and quick ratio, and so what is the advisable current ratio? How will you analyze? If anybody can give the input, what should be the advisable current ratio for any company? How we analyze? How we see the current ratio? Why 2:1? But ultimately, what is the advisable? 1.5, 1.33?
depending on the industry, it will be. Some industries have quick ratios, so it will be very quick. 2 days turnaround, 5 days turnaround.
we can apply all this. But other industries, service industries, we cannot apply all this. All these new tech companies, we cannot apply all this. They are more run by
They have also investment into the working capital. It's not necessary, but their content of the investment may differ, because manufacturing industries may have inventory, they may not have inventory, they may have trade receivable and other investment. Yes, yes, definitely. So you correctly said, you need to understand the business model, industry, and thereafter you should conclude into those part. Why sales to working capital ratio is important? So when we say sales to working capital ratio, so as a investment, there are two major investment company invest: working capital and capex. So why which is nearest one? Why company invest into the working capital? For generating the sales, definitely. So by analyzing the sales to working capital ratio, definitely you will be able to know how much time the working capital is cycled. But along with that, margin of the sales is also very important. If company is into the thin margin, then definitely those analysis should be interpreted accordingly. So as we rightly said, we can't conclude what is the standard ratio when we analyze it is in a valuation terms. For the bankers, yes, we may say that bankers insist for 2:1 debt equity or XYZ or whatever may be. But for valuation purpose, definitely we should not conclude on those ratio analysis being interpreted in the banking terms. We should analyze by the market and the peer group companies, and accordingly we try to interpret our company vis-a-vis the market and vis-a-vis the trends. So as a debt to equity ratio, we definitely say higher is the riskier, lower the opportunity cost of equity should be considered, and 100% amount of your investment through equity is also not desirable, because ultimately it will impact your return on equity in terms of the opportunity cost of equity. So DSCR, debt to EBITDA. So what is the advisable DSCR? How you interpret debt service coverage ratio? Why?
debt service is important, otherwise you will 3 months it will become NP. So debt service coverage is the most important.
It should be also analyzed vis-a-vis your the margin, how much margin company operates, because ultimately if margin of safety is not available, and if there is a difference between, by margin of safety we say the difference between the break even and actuals. If there is a little margin of safety, then definitely it should be analyzed accordingly. So what is the margin of safety is available, that also needs to be seen along with all these ratio. Why debt to EBITDA? Why we should also see debt to EBITDA? Why debt to EBITDA? Definitely, but we have also analyzed the debt service coverage ratio by why debt to EBITDA is important. So ultimately, by debt as a EBITDA, we can say that it's a cash flow profit. Okay, so whether your EBITDA is sufficient to repair your debt within next 2 to 3 years or not. So debt to EBITDA capacity also we should analyze. Debt to working capital ratio, because debt to working capital is a very immediately available with the company. Working capital, because whenever working capital is able to realize cash flow, then it will be able to repay the debt. So debt to working capital ratio should be also analyzed. Interest coverage ratio, asset turnover ratio is very extremely important. Why asset turnover ratio is very important? Because by average total assets deployed, we need to analyze it as a opportunity cost, and by the net annual assets, we should analyze is a profit earning capacity, profit generating capacity of those cells. So by asset turnover ratio, we analyze the measure of efficiency of asset to generate the income. But if the average total assets are appropriately deployed, if are able to generate the income over and over above the return on capital employed, then and then only it will give you a return on equity as desired by the any investor. Inventory turnover ratio. These are the indicative ratio analysis we all put. I will also show into the Excel sheet how we put when we carry out any analysis. Why account payable to turnover ratio is very important? What is the reason? Why we should analyze this ratio? No, it is a average account payable. Why? Because our purchase cost is basically even dependent on the how fast we pay. Nobody will give the longer credit period without any cost being impacted, cost being associated with it. Suppose if the company is enjoying the credit period of 120 days instead of 30 days, we should not be happy because their working capital is being met by that longer credit period. So basically it is a cost of its own, and if there is a cost of its own, then definitely your purchase cost will be also increased to that extent. So we should analyze that if company is going to pay their creditor as a cash discount or within 15 days, so definitely it will have its reduced cost. And if there is a reduction in the cost due to those aspects, with the shorter period credit availability on the payables, then definitely margin will increase. So accordingly, this ratio should be also analyzed. Account receivable turnover ratio, return on equity and return on capital employed, as we understood, it's the master of all analysis. Margins, EBIT margins, net profit margin. What is the PEG ratio? How it should be interpreted? So investors, PEG ratio is being analyzed to interpret the whether stock is undervalued or overvalued. So basically when we say the P ratio divided by expected EPS growth rate, if your P ratio is more than expected EPS growth rate, then we can conclude that it is overvalued. Or it may differ on the sector to sector also to a certain extent, but this ratio is widely being used by the analyst and investor for analyzing whether stock is being overvalued or undervalued. What is better, P ratio or EBITDA ratio? To P multiple should be analyzed or EBITDA multiple be analyzed? Can anybody give the input for that? Which is better to apply? EV EBITDA means P multiple or EBITDA multiple for analyzing as a valuation? When EBITDA multiple should be analyzed, when P multiple should be analyzed? Because ultimately P ratio is subject to your all depreciation, amortization, deferred tax. If I say as an investor, if you are putting a fresh money, definitely you are going to impact the capital structure of the company. When you impact the capital structure of the company, you should analyze as a EBITDA multiple. Because between the EBITDA and P, what impact is a capital structuring? Because as a EBITDA, irrespective of the capital structuring, earning to the entire company. And when you put a money as an investor, when you thought to put the money as an investor, new money as an investor into the company, then definitely, suppose they are going to issue the new shares, it will impact your capital structuring of the company. So accordingly, when capital structuring is being impacted, why? Because when you deploy the money, definitely those money would be available to the company without any interest cost being associated with it. So P ratio has a interest cost associated with it. But when you put the money as a fresh money for any expansion or for any other purpose, at that time EBITDA multiple is advisable to use rather than P multiple. But when for the share transfer purpose only, because when there are share transfer from A person to B person, at that time definitely it is not going to impact the capital structuring. Capital structuring is not going to be changed. So at that time you can also analyze on the P ratio. So as a valuation, EV to sales and EV to EBITDA, when EV to sales multiple should be applied and when EV to EBITDA multiple should be applied. EV to sales multiple should be applied when company has a standard margin, company is operating above the margin. At that time, we can conclude that with every increase in sales, company is going to earn so amount, which is concluded. Suppose for FMCG sector, we can say with every increase in sales, their margins are generally standardized. At that time, we can relate their sales EV enterprise value along with the sales. But when that margin is volatile, at that time we should also apply EV to EBITDA multiple, and widely used multiple is EV to EBITDA only in the market. These are indicative analysis of the peer industrial. You can like that. Suppose if you don't have any exact peer company, so you should look into the sector. And you search number of companies into that sector, you find out the average ratio, P ratio, price to book, return on capital, PEG ratio, return on equity, and you put your company vis-a-vis those average of all the company in the sector. So now let me come into the Excel sheet. When I told that ROE, return on equity and return on capital employed, is a master of all analysis. So now I have tried to find out, I have put 5 to 6 companies, I have removed the name, but I have tried to put what is the return on equity and how it impacts their valuation. So this company A, it is a pharma company, no borrowing. Okay. 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 There is no borrowing, zero debt. So when we say what is the difference between ROE and ROC, is your capital structuring. Now let's see this company. I have put the summary. There is detail working, but I have put the summary. So you will be able to see return on equity and return on capital employed is the same. Why? There is no borrowing. So when we say ROE and ROC is the same. Why in this company ROE is reduced? It should have reduced more also, but this company have done the buyback during this year. So ROE should not impact furthermore, so they have done the buyback. Now, how ROE is directly related with your valuation, that also I have tried to put into for our interpretation. Now let's see. For this company, vis-a-vis ROE has decreased from 21 to 23 by 26 to 26.77% negative. Accordingly, it has price has also reduced by 24%. So how ROE is being directly related with all these analysis. Now let's see the another company. This company has done amalgamation of the ABC project D with the project company. Now, this company, see, for this company, return on capital employed, return on equity is more than return on capital employed. Why? Because that company has borrowed the debt. There is a debt equity ratio of 0.55. And when the company's return on capital employed is more than cost of debt, then definitely for every additional earning, it will give the additional return on equity. So I have written, when ROE is more than ROC in 22-23 as a debt has increased, so and ROC has improved, so accordingly ROE is also improved. Now let's see for this company. Their ROE has improved by 54%, and their price has also increased by 48%. So how there is a direct relation between all those. So this is indicative for your analysis purpose. Now for this company was previously a pharma company. It has done the demerger. It has taken the NBFC registration and has acquired another NBFC company. So though there is an increase in their ROE by 137%, though their price has decreased by 59%. Why? Because business has changed. So definitely the valuation the investor will give to the pharma company and the valuation the investor will give to the NBFC company will definitely differ. So accordingly, their business model has changed, has impacted this decrease in the price. Like for this chemical company also, there is decrease in their ROE by 19%, the decrease in price by 70%. So now this another last company. There also, so you see the gap. Return on capital employed is a 20% and return on equity is a 31%. So what is the reason? So their return on capital employed is far higher, 20% than cost of debt. Definitely cost of debt could not be near to that only. It could have been 9%, 10%, whatever may be the. So there is a margin over the cost of debt is huge. And definitely with every borrowing and on the financial, by carrying out the financial leverage, the return on equity has increased to the 31%. Why? Because there is a sufficient margin is available over and above your cost of debt on entire return on capital employed. 5 to 10 minutes? Okay. Okay. Now I have tried to put this Excel sheet just to explain how we should carry out the analysis. So I have put for ceramic company as a columnar. For ceramic company as a columnar, and there even as a trend analysis for the respective company I have put 4 year, March 21, 22, 23 and September 23. So I put profit and loss, balance sheet. Now let's analyze. For this ceramic company 1, there, let's see, in March 22, their growth in turnover is 33%. Their growth in EBITDA is at 20% only. So with every increase in turnover, they are not going to increase EBITDA as should have been earned. It is decreasing. And this company is having a huge bank balance with them. Huge cash and bank balance, huge marketable securities with them. And we can also conclude that those assets are not deployed at the return they are earning from their own business activity. So accordingly, it will also impact their overall EBITDA also. Now this ceramic company 2, let's see. Their growth in the turnover is 18% and their growth in EBITDA is 37%. So there may be also lot of factor may be involved on the product mix. The ceramic company 2 is majorly dealing in the business which is high margin items. Ceramic company 1 is dealing in the business which is a low margin item, means low margin items than that ceramic company 2 is dealing. So which type of product mix it is a dealing, that also should be analyzed. So by this analysis I want to say that we should analyze as an increase and decrease in turnover, increase and decrease in EBITDA, increase and decrease in EBIT and EBITDA. So what is the difference between EBIT and EBITDA? definitely your capital structuring. So now another. You should bifurcate core working capital being deployed into the business, incremental working capital and incremental sales vis-a-vis that working capital deployed, because as we already discussed in the previous slide, capex and investment in capex and working capital are the two foremost investment being deployed by any business for their running their own business activity. Other than I'm talking about the other investment in subsidiaries or whatever may be. But when we say in our own business activity, only these two activity, working capital and capex. So we should put these as a incremental capex and in incremental working capital. And what incremental, suppose in this company, ceramic company 1, their incremental capex is 17%, but incremental sales is 33%. Why? Because this company is, by using their brand name, it is carrying out the outsourcing of their product manufacturing being outsourced and contract manufactured from other smaller units. So definitely to avoid their capex risk, definitely it will give the lower margin, but they have analyzed accordingly. They have analyzed that though I am putting a capex, incremental capex of 17%, but my turnover has increased double than that. So this is the, we can say, liquidity analysis. Likewise the efficiency ratio analysis, asset turnover ratio, sales to average fixed asset, sales to average total current assets. So this is the indicative analysis how you should put into the Excel sheet, and you should analyze vis-a-vis the peer group and vis-a-vis your historical trend analysis. Both are very important, because if we say we have generated the cash flow from working capital during the year, it doesn't mean that we are efficient in the working capital management. Because if in the previous year, as a normalization comparison, we should have invested working capital of say 100 crore. But we have already invested 150 crore. And if during the year, it is from 150 crore and if it has come down to 120 crore, definitely as a cash flow, it will look better to us that 30 crore has been realized. But though it is not to the mark, because already we are deploying more than the peer companies and more than the industrial benchmarks. Solvency ratio and valuation ratio, as we interpreted that EV to sales, EV to EBITDA, PG ratio. So I have put it just indicative ratio analysis, how you should analyze any financial statement, and definitely which ratio to be interpreted in which manner, what is the benchmark, what is the best, definitely depend on industry to industries, and it is not, we cannot generalize it in any manner. So this just I put whatever analysis I can. I have a little time, and I can produce and share my knowledge with all you experts, your chartered accountant experts here in the audience. And if anyone have any questions to discuss, so please put the questions so we can discuss, and I can try to reply. Thank you for giving me the opportunity to give and share my views, Nirav bhai. Thank you very much. Thank you.
Shilpang bhai, for such a wonderful session. We chartered accountants are very close to the numbers, and when it comes to have some analysis with the number, we are very fond and we are very connected to the session. Thank you so much, sir. It gives me an immense pleasure on behalf of all the members present to propose a very heartiest vote of thanks. Sir, kindly accept our sincere gratitude and thanks on behalf of all the members present. Would like to have you again soon on the same topic or some other topic with your rich and experienced knowledge. Thank you. Members, we are having a quick 15 minutes of tea break. Tea will be available downstairs. And post tea break session, we'll be assembled back at the same hall for the last final session of this two-day conference on stock market. Thank you.